Welcome back, friends, and let me start with some more discussion for the corporate taxation. And I want you guys to come to this particular page, and one of the very valuable. This is also one of the very valuable past examination question about 16 marks, and very high value and very good concepts. I mean, even today, the concepts of this particular question can get repeated. I mean, of course, never a question will get repeated verbatim, but concepts can very well get repeated. And this can also be taken as a question for the international taxation because it involves some foreign company, foreign branch, and kind of the situation. So wherever this word foreign comes or foreign company comes, all these questions are as good as can be included in the international taxation chapter also. So friends, come to this particular page and let me read the question first. And all right, the profit and loss account of Indian branch of a Bank of UK, a bank incorporated in United Kingdom, for the year shows a net profit of rupees 60 crores after debiting and crediting the following items. Depreciation, all the rupees are in 2 crores. Interest on fixed deposit, from which the tax was deducted at source under section 194A but was deposited before the due date of filing of the return. Interest on government securities accrued but not due. Reversal of interest income recognized in the previous year 2 years back in respect of the term loan, which was classified as substandard asset in that year as per the prudential norms of the Reserve Bank of India. The reversal of the interest was made on the basis of inspection report of the Reserve Bank of India in the month of September. Profit on sale of vacant land situated in Noida, Uttar Pradesh, to a company incorporated in the New Zealand pursuant to an agreement entered in UK, for which the payment was also made in UK. Net depreciation on investment under held for trading and available for sale categories on lower of cost or market price as per the prudential guidelines of the Reserve Bank of India. Bad debts written off in respect of the advances classified as loss assets. Provision for non-performing assets as per the prudential norms of the Reserve Bank of India. Indian branch share of executive and the general administrative expense as per the debit note raised by the head office. Other relevant information. 1. Interest on government securities accrued but not due for the last 5 crores of last year is rupees 5 crores, which was credited to the profit and loss account for the last year. The depreciation liable under income tax rules is rupees 12 crores. The assessee was allowed a deduction of rupees 10 crores for the provision for bad debts under the provisions of 36(1)(7) till last year, and it wrote off the bad debts for the first time in the previous year. The interest on substandard and the doubtful categories of the advance not recognized as income as per the prudential norms of the Reserve Bank of India is rupees 15 crores. Land at Noida was acquired by branch at a cost of rupees 9 crore. Index cost is 14.58 crores the few years back. Compute the total income and the tax payable by the Indian branch of a Bank of a UK, ignoring the applicability of the provisions relating to the minimum alternate tax. Give explanation for the treatment of each of the items. Beauty question, beauty. Friends, take your own time. I mean, let us not hurry for solving a good question like this, and let us try to understand every aspect of this particular question. And of course, as per my style, I don't want to just solve the question, but I want this question to be really understood. That means if any such adjustment, any such concept which may come as a different question in examination condition, you should be able to solve it. There's always, friends, my objective is not just to solve, but my objective is to fully understand and then solve. Take your own time, friends, and don't worry, even if you take some more time, I have no objection, friends. And only thing that I'm trying to tell you is that you got to understand the hardcore basic things first, well, before the starting of the question, and thereafter you should go ahead and try to crack it. I mean, open your book, material. Let me also open up my book, but I will not start solving right now. I mean, I want to take a very, very handsome time, and I want to solve it like a pro. Question ID number is 18. UK Bank, Indian branch. The situation which is given to us is clearly something like majority of the international transaction. So friends, this particular question is basically the part of the chapter of international taxation. But we are doing it here because it's more towards the corporate taxation. But this type question, I'm just telling you, this type question can be included in the international taxation paper. That's the reason I'm writing international taxation. Because nowadays the institute is coming out with a separate demarcation and separate importance for international taxation. And that is why I'm doing this. As usual, we will always start with profit as per P&L. This will be our beginning point. Thereafter, we are going to do all those adjustments. This is how it is going to start, friends. But I'm in no hurry, friends. First of all, I want to understand, oh my, all the damn aspect of the question. I want to go close. I want to understand this particular question so that I inevitably able to solve it first. Then I want to solve it. Before I go ahead, I want you all guys to understand that this question type that you are seeing and that I am solving and I am discussing with you, this question type is basically 16 mark to 20 mark types in the examination condition. So it depends that sometimes this 2, 3, 4 marks weightage, plus minus, that is dependent upon the paper setter. I mean, to an extent it is based on his mood, I believe. But that particular point is very important, that supposing this question comes for 16 marks. Roughly, in examination conditions, for every 1 mark, you are getting 1.5 minutes to solve. Roughly, I'm just telling you. Roughly. So it is 100 mark paper. You are got 3 hours, so 180 minutes. So 1 mark per minute, that means 150 minutes allocated. Extra 30 minutes, somewhere some plus minus and all that can happen. Your target for a question like this to solve in the examination condition should be straight away max 25 minutes. So in classroom when I'm going to solve, it is going to take much more time. Minimum, I think that this is 1 to 1.5 hours roughly this particular question is going to go. Roughly I'm telling you. And that too I'm telling you when I am into the video class situation. If my actual classroom, because there the 100 students seated. So then I got to make that kind of, what should I say, tally with all the students' eyes. So there, entire 3 hours lecture will go only for one question. In video class, to an extent, the time is saved. But again, in video class, we are giving more time for doing more and more questions. I mean, the work done is much more. So it's a kind of a trade-off. Okay. But your target should be approximately 25 minutes. In that, you got to read the question, you got to understand the question, you got to solve the question, you got to also finish your calculator work. And this is the question where normally students feel that, oh, you don't know 2-3 adjustments. So normally you feel that you are stuck only. That means you can't go ahead only in that particular. That kind of feeling also sometimes some students get. There are some questions are like that, where you don't know 2-3 adjustment, but still you can complete the question. But in the question like this, if you don't know those 2-3 adjustments, you get a feeling that you can't proceed. That means you have to leave half the way. You feel like that. You don't know, even I don't know. There is going to be many extra concepts. There is going to be many extra words, many new terms that will come. I mean, this kind of language of this particular question, like this is as per the prudential norms of the Reserve Bank of India, something like that. This kind of language you might not have experienced in the previous questions. You might not have experienced. So it could matter. It could matter. The language itself is like, a lot of, because with respect to a banking sector. Investments available for sale and kind of things. Look at this kind of language. Held for trading, available for sale. This kind of words with open and close inverted commas. So each and every words and the phrase you got to understand, and then you got to come close to the answer. Don't hurry. At least for our classwork purpose, you don't hurry. Examination condition, you can start cracking. I mean, you should do that actually. But for classroom purpose, I'm going to spend the good amount of time to make you understand each and every adjustment. Why we are doing it? What is the meaning of question? What is the meaning of answer? Everything. Okay. Now, in light of that, let us start with the basic discussion of this particular question. Let us start step by step. The profit and loss account of the Indian branch of a Bank of UK. Bank of UK. And it is a Indian branch. In India, we are going to tax with respect to the assessee. Keep this in mind. Assessee. Just imagine this way. Assessee. Any question comes. Just understand, friends. Any question comes, whether it is in this chapter or any other chapter, you are solving question for whom? You are solving the question with respect to the word assessee. You should always imagine that who is the assessee that you are talking about. Why there is a complication? I'm telling you why there is a complication. First of all, you are told that profit and loss account of the Indian branch of a UK bank. Okay, so name of the bank as such, not let us say that XYZ bank. So that XYZ bank is the assessee. Just imagine that way. Because if that XYZ bank is the assessee, then this bank is going to have a global operations. That particular bank is going to have a global operation, because this is not just Indian operation and the UK operations. So are you going to tax the entire global income, or are you going to tax only the Indian income? Are you getting it what I'm trying to say? So whether the entire global operations of this particular bank will be taxable in India, only the Indian operation will be taxable. Because who is the assessee? And these small things really matters in the international taxation. In other words, supposing the Indian government will say that no, you are a Bank of UK, you have so many global subsidiaries. In real life, I'm telling you, this majority of these popular top 10 banks, no, you name any of these top 10 banks, for example, Citibank, Goldman Sachs, JP Morgan, European banks like HSBC, Credit Suisse, Deutsche Bank, German Bank. These banks around the world, they have 3,000 to 5,000 subsidiaries. You will just imagine, oh my God, what kind of business that these banks are doing. 3,000 subsidiaries. You see their actual annual reports. Their respective governments are also going mad behind this bank. This banking sector is just like a dragon, you know. Every small little business, they put it into a subsidiary. I mean, God knows why. It's all about their disclosures and hiding of profits and showing off profits and this, that kind of things. They want to fool the governments across the world. So first thing that, supposing Indian government says that now you got to pay tax on your global operations in India, this bank is going to go mad. Very next day, they are going to wind up their business from India. They say, we don't want Indians anymore. That kind of reaction these bankers will give. So, I mean, these are the hardcore basic things, friends. Hardcore basic things of international taxation, and that should always be in your mind. Always be in your mind, okay? So, the basic clarification, the conceptual clarifications, okay? Assessee is a UK bank, but Indian branch, particularly with respect to the banking sector, I'm telling you, particularly with respect to the banking sector, okay? This Indian branch will be regarded as independent unit of taxation. I repeat, will be regarded as an independent unit or independent assessee. As such, branch is not an assessee. Keep that in mind. I repeat, friends, a branch of a bank is not an assessee. It is not a corporate body. But this branch of a foreign bank in India will be taken as a separately assessable entity from the tax law point of view. And this is clarified by many court cases, some of the board clarifications, a lot of things are there behind this particular thing. So I'm not going into those technical aspects, but that I got to do it. A lot of discussion, friends, in our international taxation elective paper. Supposing if you're taking that elective paper, 100 marks, open book exam for CA final. And if you're taking that subject from me, and if you're going to learn it from me, suppose, then you're going to get those kind of nasty things, friends. I once again repeat, a branch is not an assessee. A branch is not an assessee. There is no taxation with respect to a branch. But particularly with respect to the banking sector, this because they have the global operations, the Indian branch by itself will be taken as independently assessable entity. Okay, so we got to write notes. We got to write notes. Okay, but that I'll do it, friends, in just some time to go. Bank was incorporated in United Kingdom. So this is a foreign bank. That means it is a foreign company. And therefore, the tax rates applicable will be with respect to foreign company. All basic things should be kept in mind. Okay. So if you see here, the bottom line of the question, compute the total income. So you have to compute the total income and the tax payable by it. And the tax payable by it. So this is a foreign bank. So foreign bank will be at the rates applicable to the foreign company, surcharge applicable to the foreign company, and the cess. The surcharge applicable to Indian company is a separate rates. Surcharge applicable to the foreign company is a separate rates. So when it comes to the tax liability calculations, you got to have that presence of mind. This is not an Indian company. This is not an Indian bank. This is not a State Bank of India. This is a UK bank and having a branch in India. So all the rates, tax liability calculations, you got to do it keeping in mind the foreign company rates of taxes. Surcharge is a separate rate. So that rate card I have already given it to you separately. So you have to use the rate card with respect to the foreign company. Keep all these basic things in your back memory and your coconut. Then, ignoring the applicability of the provisions of minimum alternate tax. So, to that extent, in this particular question, there is a relief. It is clearly printed that you have to calculate total income and the tax payable. Normally, whenever you say that the tax payable, that means you should do the MAT calculations, because you never get the tax payable without applying the provisions of the MAT. But in the given question, it is clearly printed. It is clearly printed in the question itself that you have to ignore the MAT. That means to that extent, oh my God, I'm saved. Something like that. Okay. So that's it. So first of all, it's a foreign bank, Indian branch. Those notes I will write at the end. And foreign companies, so rates of foreign companies, surcharge, if any, of the foreign company. And you should note that all the figures are into crores. Where it will make the difference, in the surcharge it will make the difference. Because the style of law is that if the income is more than the limit, then the surcharge rate is this, and if it is more than this, then the surcharge rate is this. The surcharge rate is dependent upon how much total income that the assessee has got it. Okay, so keep that in mind, but those things will matter towards the end. Okay, now, so I will start net profit of 60 crores, debit credit of the following items, and this 60 crores is of the Indian branch. That means this is out of the Indian operations. This is 60 crores not out of the global operation. This is 60 crores out of Indian operations. Okay. Now let's go step by step each and every item. So I can just open up my answer. 1 second. How should I go ahead? 1 second. Profit as per P&L is 60 crores. So I'll write here 60. All rupees are in the crores. So I'm giving the title crores. Then all the headless adjustments. Okay. So adjustment number 1. Let's go ahead and proceed and do all the kind of depreciation. Okay. So what do you do with the depreciation normally? Book a depreciation add and the income tax depreciation less. Okay. Now the question interpretation I'm telling you. If you read this particular question, it says that after debiting and crediting of the following items. So which are the following items? All the items which are printed to you in the table. After the completion of the table, what is printed to you is other relevant information. After the completion of the table, what is printed to you is other relevant information. Correct? What do you mean by this other relevant information? That means these particular points, as per the question interpretation, they are not covered by debits and credits. And that's the reason this point 1, 2, 3, 4, 5 is not included in the above table. So that's a question understanding and the question interpretation. So all the points which are printed in the table, they are debited, credited in the books of accounts. That means a profit and loss. Okay. And not necessarily profit and loss. It can be debit credit and anywhere debit credits. Okay. And other relevant information means they are not debited credited logically. So there are some extra inputs given to us for the question solving. Okay. So depreciation as per the books is this figure. And whether any depreciation as per the income tax law given in any of the adjustments. Yeah. Depreciation allowable under income tax rules is rupees 12 crores. So we can do the first adjustment. Book depreciation add and the tax depreciation less. Okay. So let me go ahead and point number 1. depreciation as per the books. And I will just say the additional information too, just for the sake of, what should I say, for the sake of brevity, so that I can just, at the end of the answer, I can just check whether all those additional information I used it or not. So it's just a symbolical representation, friends. And that extra point which I call it as A2, and depreciation as per income tax. So book depreciation was 10, so that will be added to the profit, and income tax depreciation will be deducted from the profits. I'm giving you one hint, friends. One hint I'm just telling you at this level. See, normally, bad debts, because this question is magnificent point towards the bad debts. A lot of bad debts adjustments and all that things are there with respect to the banks. So, bad debts also logically have the same treatment. Bad debts as per the books, we will add it. And whatever is the bad debts permissible as per the provisions of the law, we will deduct it. Keep that point in your back memory. So, just like you do book depreciation add and the tax depreciation less, same thing. Book bad debts add, everything add, and bad debts as per the income tax law will be less. It's a very important hint, friends. I've already given it to you. Okay, come on, next point. Let me erase this. Interest on fixed deposits from which the tax was deducted at source under section 194A but was deposited before the due date of the filing of the return of income. What is this? I guess that you remember in the business income chapter that we have already discussed, we call it as something like TDS compliances. So if you are having any expenditure specified ones, here it is, or deducted, tax was deducted and it was deposited before the due date of the filing of the return of income. So that's a sufficient compliance. Normally though you should deposit before the due date of the TDS chapter only at the respective places, but in the given case it is at least done before the due date. That is also tolerated by the income tax law. So this interest on fixed deposits. So this is your expense. And for a bank, majority of the income will be interest income and the interest expenses. By and large, the bankers are going to have this only as a character of their income. So deposited before the due date of the filing of return. So it is already complied with. So we'll say that, okay, we don't need any disallowance because TDS compliance for the interest expenditure is already done. Okay. So let me update. Interest expense. No adjustment is required. If you want to note, you can note a section number, section 40A. TDS compliance is done before the due date of the filing of return of income, and thus no disallowance is warranted. Okay. Point number 3. Interest on government securities accrued but not due. Very good point. Very good point. Interest on government securities which is accrued but not due. What I mean by this? Let me bring one very valuable point to your notice. I also discussed this particular point importantly. I'll tell you which chapter I will tell you. There more depth I've already discussed, that is your income from other sources. But in the given case, income from other sources can't apply because this is business of the bank. But concept is the same. So whether it is a business of the bank or it is for the investor, the interest on securities, okay, that concept is the same. What is that concept? Read section 145, the method of accounting, with section 7 and section 8 of the Income Tax Act, where interest dividend type extra clarifications is there, where the income tax law says that interest on securities by default is taxable on the due basis. I repeat, interest on securities by the specific provisions of the Income Tax Act, section 7 and section 8, read them together with section 145, expressly makes it very clear that interest on securities by default will always be taxable on the due basis. And what is the difference between due and the accrual? I will also tell you that also. Okay. See, this is my time sequence. This is my previous year. Okay. April, May, June, July, August, September, October, November, December, January, February, and the March. Okay. All the 12 months. Now, government securities, say for example, it says that that means the security terms condition says that every year the interest is payable annually and at the end of the December. So this is your date when it falls due. Just imagine with the help of an example and understand the concept. So as per the terms of the securities, it is said that you will be paid interest annually and on the 31st of December. That's a deadline as per the terms. Is that okay? So when you say that it is taxable on the due basis, that means it is taxable with respect to the month of December. December is in the previous year, naturally, and therefore it will be taxable with respect to the due date and not with respect to the accrual. Okay. Now, what difference? Because every year the December is anyway going to come. See, you just imagine, every year the December is always going to come. So, payable annually, so 12 months interest in the month of December, it is 12 months interest, so always will be taxable 12 months interest in the respective previous year. Correct. But the first and the last year can make the difference. The first year and the last year of the interest on securities can make the difference. Logically, I am just telling you. Okay. Now, say for example, you have invested in the security. For example, your investment is in the month of February. But the interest is payable, it becomes due only in the month of December, but you have invested in the security in the month of February. Is that clear? Okay. So, for the given previous year, first year of your investment, okay. So, I assume that you have done it on 1st of February. So, you have 2 months, okay. So, you have 2 months interest already accrued. You have already 2 months, that means February and March. 2 months, it is already accrued interest. But it is not due. Nothing is due for the 2 months because it always falls due in the month of the December. So, you might accrue the 2 months interest as per your generally accepted system, that you will say that, okay, I'm going to accrue 2 months interest as your income. You will show it as your income. But if it is not due, that means taxability is not there by default. By default, there is no taxability because there is nothing which falls due after you have invested in the security, the specified government security. Have you understood that? So this can make the difference in the first year of the investment or sometimes in the last year of the investments. Sometimes I'm just telling you. In the given question, if you read, interest on government securities is accrued. That means for 2 months, say for example, I just assume that you have already accrued it, but nothing is due. And if nothing is due, nothing will be taxable under the tax laws. And only one caveat is that unless this particular bank was following a special method of accruing the interest specifically, then it could be a different, that means then you can tax on accrual basis, but it's a very exceptional kind of a situation. But by default, where no extra inputs have been given to us, we have to understand and accept that as per section 7 and 8, read with section 145 of the Income Tax Act, it is taxable only on the due basis and nothing is due. So at least this year there is no taxability. So in the books of accounts you have already accrued this figure of 3 lakhs. Okay, but it will not be taxable. Okay, further, this 3 lakh rupees is already debited or credited. So it is already credited to your profit and loss account, but it is not your taxable income because it is not due. So let's make a note of that. Point number 3. Interest on securities not due. So this money will not be taxable. It is already credited to P&L on accrual basis, but it is not taxable. So that concept of taxation of interest comes into the picture here. Okay. Let me write a note. As per section 7, 8, read with section 145. Interest on securities is taxable on the due basis. Interest on securities is taxable on due basis. Since nothing is due for the previous year, it shall not be taxable for the year. Okay. Example, I will just repeat and I will just make it official. For example, now I will not write all the months, I will just say quarter. Okay. So, say quarter 1, quarter 2, quarter 3 and quarter 4. Okay. Now, supposing if it falls due here, so April, May, June, July, August, September. Suppose as per the terms of the securities, how will you come to know real life when is it falling due? For that you have to read the securities. Every security will have its own terms. It is not some universal thing, but it is subjected to terms conditions of the security investments. So if it falls due, then after the payment of the quarter 2, okay, this is accrued but not due. This quarter also is accrued but not due. So it is taxable on due basis. That means if it is due during the year, of course, final decision to take it for the year only. So if it is due for the year, it will be taxed. But as I already told you that normally this concept will matter in the first and the last year of the investment sometimes. Normally. Otherwise, what happens for an ongoing years? No, every year it will fall due. Somewhere in the year, though, it will fall due. Okay. So every year it will fall due and every year there will be a 12 months interest, but on the due basis. But that first year and the last year can make the difference. Okay. So I've already done that point number 3. Have a look of the answer, friends. So far, so good. Update your answer. Similarly, we got to handle all the adjustments, and this is a good question, baby. Okay, so come on. Next part of the question. The reversal of interest income recognized in the previous year 2 years back in respect of the term loan, which was classified as a substandard asset in that year, as per the prudential norms of the Reserve Bank of India, the reversal of the interest was made on the basis of inspection report of the Reserve Bank of India in the month of September. What does that mean? We got to read this particular point, and amount is given to me some X amount. We are not worried about the amount which is printed here, but we want to learn this particular concept. Reversal of interest income recognized. Reversal of interest income which is recognized 2 years back in respect of the term loan which was classified as a substandard assets. In that year, as per the prudential norms of the Reserve Bank of India, the reversal of the interest was made on the basis of inspection report of the Reserve Bank of India in the month of September. Oh my God. It is a reversal of interest income recognized 2 years back. See, I just want you all guys to imagine. See, there is something called as bad debts. And there is something called as recovery of bad debts. These are two terms. You already know that very well. Bad debts means you write off and you get a deduction. And whenever there is any recovery of the bad debts, it is a deemed income and it is always taxable. That is also covered by concept of section 41 of the Income Tax Act. So if you got any deduction in the earlier years, and for those deductions of the earlier years, if there is a current year, there is a recovery. But here the term which is used is something called as a reversal. Now see, there was some interest income, there was some account of your person to whom the money was lent. It was classified as a substandard asset in that year. So bank lend money and bank get the interest income. So bank have the debtors. That means banks have given advance to that particular person. Okay. So when the banker has given an advance, there was a possibility that that advance goes bad. It is a bad loan of the banks. So here they are not using the word like bad debts, but they are using the word called as a substandard asset. This substandard asset is none other than the bad debts. And it was classified as a substandard assets. That means it was already written off that way. It was already classified, and as per the banking terms, the substandard assets gets written off. And it should be as per the prudential norms of the Reserve Bank of India. That means banker cannot say each and every bad debts, because classification of the bad debts or the bad loans or a substandard assets is done as per the rules, banking rules. So that was already done 2 years back. Just understand this way. So it was already substandard. That means it was already bad, and it was bad 2 years back. Okay. Now there is a reversal of the interest was made on the basis of the inspection report. So maybe now again as per the RBI rules regulations only, now it is no longer substandard. Now it is no longer a substandard. So what you do is you write back. So 2 years back it was a substandard asset. So you wrote off, and this year, that means current previous year, it is not classified as a substandard asset, and so it is written back. So, is it income? That means, is it a normal proper accounting entry? The answer is yes. Okay. And this is anyway the income, a taxable income, because what we are doing is a computation of a taxable income. This amount is already debited or credited at the respective places. Is that okay? And so, this particular point is anyway the income, it is already credited to the profit and loss. So, we are not supposed to do any adjustment. But I once again repeat, friends, in the given case, what is used is classified as a substandard asset, but it was classified as a substandard 2 years back. Substandard means bad. So, it was bad 2 years back. So, it was logical understanding as per the banking terminology that it was written off. And now the reversal is done. Now it is a reversal done. Reversal means recovery of bad debts. But friends, I cannot write these words in the examination condition. I cannot write bad debts. I cannot write recovery of bad debts. I have to use the word substandard and the recovery of substandard. Because the banking terminology, these banking terms have to be used because question is based on banks. Okay. So, let me write a answer, update my answer. Point number 4, okay. Reversal of substandard assets. Actually, it is loan only for our better understanding. Okay. Assume that in the earlier years, it was allowed as a deduction to the assessee. Assumed that in the earlier years, that means in the preceding year, logically 2 years back, it was allowed as a deduction to the assessee, and thus in the previous year, it will be the income of the assessee. This is one of the very important assumption. Very important assumption. So, no adjustments are required. It is already credited, already debited or credited. Since it is already debited and already credited, so we do not require any adjustment. It is correctly credited to your P&L and it is your income. Now, let me tell you why this assumption is very important. Why this assumption is very important. That in the earlier years, when it was allowed as a deduction, only then in the current year it can be taxed as income. Only then in the current year it can be taxed as income. For example, bad debts. I'll relate it with the word bad debts because word bad debts is very simple for students to understand. The bad debts, when you write off, the income tax should have given you a deduction. There are many situations where the assessee write off the bad debts, but the income tax officer do not give the deduction. And in the subsequent year, there is a recovery of the bad debts. So the recovery of the bad debts is taxable only if in the preceding years, the income tax officer would have given the deduction. If in the preceding year, the income tax officer did not give the deduction, now then the recovery of bad debts cannot be the income because in the earlier years, you have not got any deduction for it. So this assumption, this note is very important in the given situation. Okay. Let us go to the next point. This is done. This is done. Okay. Profit on sale of a vacant land situated in Noida, Uttar Pradesh, to a company incorporated in New Zealand pursuant to an agreement entered into in UK, for which the payment was also made in UK. This is also one fundamental concept of international taxation. Profit on sale of asset. Just imagine that way. It is a profit on sale of asset, and that asset is located in India. Sorry. You are selling the land. You are selling the land in Noida. Maybe you have signed the document in New Zealand. It is printed. You have signed the document maybe in the New Zealand. Agreement is entered in UK. Payment was also made in UK. So it is land in India, agreement outside India, payment outside India, but the asset actually, because it is immovable property, so immovable property is inside India. So if there is any sale of immovable property in India, it's always taxable because it is always deemed to accrue or arise in India. Because land is in Noida, it is always going to accrue or arise in India. So income out of the transfer of any assets in India is always taxable in India. Now for this particular land, we have got some extra inputs also. Let me just check that point. See, this is profit on sale of. So we got to be more attentive now. This is a profit on sale of. So this figure is a profit figure. Secondly, this figure of 10 will be subjected to the capital gains treatment because it was a vacant land. For a bank, vacant land is not a stock in trade. Okay. So for a bank, it is a capital asset. And point number 5, some extra inputs are there. Let us read that. Land at Noida was acquired by a branch at the cost of 9 crores. The cost printed is 9 crores. Index cost is this. So logically, the law is trying to say it is a long term. Okay. Few years back. So how do you compute the capital gains? See, your profit is 10. So what you need is a full value of consideration. You need a cost. You want the index cost. Index cost is ready-made printed 14.58. The cost is already given to you is about 9 crores. So it indicates that this is your long term. But what is going to be the full value of consideration? So the full value of consideration, you need the selling price. But this is only a profit. And this is your cost. Where is your cost gone? 9 crores. So our selling price is going to be the cost plus profit. That's one of a small little catch. This is going to be your actual full value of consideration. Logically called as a sale price. Because 10 crores which is printed in the question is not a selling price. The 10 crores is printed as profit on sale of. So in your profit and loss account, you have credited only the profit. The correct entry you have passed. So it's like your sale price is 19 crores. Then your index cost is 14.58 crores. And this difference is going to be your capital gains. It is going to be a long-term capital gains, and the long-term capital gains will be subjected to the special rates of tax. So ultimately, what kind of adjustment that I'm going to do now? I mean, how is my answer going to look like? First of all, I want to do it headwise. No, first of all, I want to do all this computation headwise. So I want that business income computation and the capital gains computation. So this profit figure, I will exclude it from the business head because I am doing the computation of business income. I will exclude it from business income, but I will include it in the capital gains. Okay. And in the capital gains, I am going to compute my capital gains as 19 minus 14.58. And how did I get this 19? 19 is 9 plus 10. So 10 is profit, 9 is cost. So my selling price is going to be 19. And index cost is ready-made printed to me. Index cost is ready-made printed to me. So I will just use it. Okay. So I can just start updating my answer. Point number 5. Profit on sale of land. This is a capital asset. It will be taken under the head capital gains. It will be taken under the head capital gains. Correct? So I'm going to exclude this 10. It is already credited to P&L. It is already credited because the title of that table was already debited and credited. So it is already credited to the P&L. So I'm going to exclude it. Then I have to leave some space. Now I don't know how much space that I require. So I think that I will leave the entire balance page. Let me see how much space that I have. Because that call also I have to keep on taking. Otherwise, you know what I have to do in the examination condition? I have to remember that point. And after I do that business income computation, then I have to write that capital gains. But I would not like to do that way. So this is about almost 70% of the page I have. But I think that still I may need some extra space. So what I will do is next page, half page somewhere here, I will leave handsome space. That is what I'm just trying to teach you, friends. Leave handsome. Don't care about stationery here. So in the next page, I'll leave more than half a page or approximately half a page. And then I will just update my answer. Okay. So somewhere here, income under the head capital gains, sale of land at Noida, the transfer of asset in India, thus it is deemed to accrue or arise in India. I'm just writing every small little comment because in examination condition, mamma mia, I want good marks. Okay. Selling price will be equal to cost plus profit. Profit printed 10, cost printed is 9. So this is going to be 19. Here students have done, actually I know those students who have gone for the exam, this particular question, they have done a lot of mistakes. I mean, they really had a nasty time in examination condition. Okay. So the computation is done as full value of consideration minus the cost of acquisition. However, index cost is already given to us, so we have to index it. The cost is 9, so I'll keep it in the insert column. Full value of consideration 19. Index cost is 14.58. 1 second, let me reconfirm it. Yeah, 14.58. So difference is my capital gains, that is 4.42. This is going to be long-term capital gains. Important to make a note here, long-term capital gains, because index cost is ready-made given to us. Alright, and therefore, when you do the tax liability calculations, that time this will matter you. Okay, so I have already done this adjustment. Now I'll go back. And I've already excluded the profit and already done that capital gains adjustment. So almost through. Okay, so this is done. Profit on sale of vacant land is done. Next, net depreciation on investments under held for trading and available for sale categories on lower of cost or a market price as per the prudential guidelines of the Reserve Bank of India. What does this mean? And what is this? For a bank. So your assess is a bank. You had a land. So we said that it was a capital asset. Just see the previous adjustment. Profit and sale of vacant land situated in Noida. So what did we say that particular point? We said that it was a land to a bank, and that is land to a bank is a capital asset. And that's the reason we said that it will go under the head capital gains. In appropriate computation, we have already done it. But now it is investments held for trading. So even to a bank, the investments can be long-term investments or it was a trading investment. But in the given case, it is a pure trading investment. For a banker, these trading investments are stock in trade. That is very important point to be noted. Trading investments are a stock in trade. One more important thing I'm just telling you. For a bank, listen to this very carefully, baby. For a bank, listen to this very carefully, very carefully. For a bank, cash is also a stock in trade. For a bank, cash is a stock in trade. Supposing if you lost it, for example, I'll just forget about this particular question because couple of judgments let me just bring to your notice, sweetheart. So, for example, there was a bank robbery. Just imagine like that. Nowadays, though, we don't have that common frequent bank robberies. But if you see the history, there is a very big history of bank robbery and dacoities and kind of things. Dacoity and robbery. So, those dacoits will come. Dacoits means all dakus. You know, those people who ride on the horse and come, tak, 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 tak. In the old movies, you can see, they are all dacoits. So, for example, there is a bank and if there is a bank robbery and the bank loses the cash. Okay. So, what will you say? Is a loss of asset or a loss of stock in trade? So, it will be categorized from the income tax point of view as a loss of a stock in trade and it will be given to as an income tax deduction. Same thing here with respect to the investments. The trading investments, I repeat and I focus on these words, baby, that the trading investments, I repeat, the trading investments are stock in trade to the bank. Okay, and look at the words which is used, held for trading and available for sale. That means this is what the bank is always trading. Okay. Categories on lower of cost market price as per the prudential norms of this thing. So this is a net depreciation on the trading investment. That means your mark to market kind of situation. So your value of a trading investments has depreciated. See, for example, put it differently. Forget about this point. Let me erase this. Okay. For example, you say stock. Just understand this particular concept. Forget about this question also. Let's talk about a manufacturing company. A manufacturing company has, say, for example, got a stock in trade. Okay. The cost of manufacturing is, say, for example, 10. The cost of manufacturing is, say, for example, 10. Okay. Now, what is our stock valuation method? Cost or market value, whichever is lower. So this is going to be your closing stock. Okay, your closing stock is cost or market value, whichever is less. Supposing cost is 10, market value is 8. So closing stock you are going to value at how much? 8. So if you put it into the trading account point of view, so cost is 10 and the closing stock is 8. So net effect to the profit and loss is some sort of a deduction because the market value has decreased. Cost market value, whichever is less. So indirectly, you get a deduction under the tax law of 2 by valuing your inventory at cost market value, whichever is less. Because to that extent, your profit decreases. You know, I oftenly give the example. I oftenly give this example to my students. I tell them that, say for example, just imagine. Say for example, there is a owner of a poultry farm. I repeat, there's a owner of a poultry farm. In the poultry farm, they have chickens. In the poultry farm, they have chickens. And chickens give them eggs and they sell the eggs. Okay, so that's a kind of a attitude. Okay, so in a poultry farm, you have chicken. Now, during the year, so many chickens die. I mean, because they have a huge quantity of chickens, no? In the poultry farm, their whole idea is to sell the chicken and their idea is to sell the eggs. Both they are selling. Chicken also they are selling, eggs also they are selling. Okay. So, during the year, there are so many chickens that die. And so many new eggs come. So many new chickens get born. Every year it happens, no? Because he is into the business of poultry farming. So are you going to keep the account of all that? That how many chickens were born, how many chickens died, or something like that? Supposing if the question gives you some data that there were 5,000 chickens opening stock and this many chickens were born in the year, so many eggs were given during the year and the closing stock of chicken is this and closing stock of eggs is this or something like that. Are you going to do all these separate calculations? No, it's not required to be done. See, what to do is for a poultry farm, I'll just tell you this way. You should know the opening stock, you should know the closing stock. For the people who are doing business of poultry farm, okay, you will know the opening stock, you will know the closing stock. So you will put these two numbers. Okay, these two numbers logically takes care of everything. Logically takes care of everything. Chickens died, chicken born, chicken happened this, chicken happened that, because closing stock, cost market value, whichever is less, that means logically you are getting full deduction for any life and death of the chickens during the year. So not to maintain the records of those life and deaths of the chicken. How many born? What name did you put? No, you're not supposed to do that. Because it's your inventory. So inventory, opening closing stock valuation is so important, friends. Because that opening closing stock valuation by itself logically gives you indirect deduction under the tax laws. But only if it is a stock in trade and not otherwise. Okay. Now, if you come to this particular question, it was held for trading. So, it was a stock in trade. That is very important to know here. It is a stock in trade and this is a net depreciation. I mean, just the understanding of the question. What is the net depreciation? So, probably this is a difference of opening closing stock. That is what you call as a net depreciation. Why the word net is been used in the question. So you had the opening trading investments and the closing trading investments. And this difference is this figure and the word depreciation is used. That's the reason this money is a lost money and that's the reason it is a debited figure. But the next question is that, is this particular figure correctly debited? Answer is yes. Answer is yes. Because for the bank, this is a stock in trade. So this net depreciation is already allowable as deduction and it should be given. Okay. So, however, this particular question, no, this particular question is not given in that opening closing figure and all that. Because if that would have been given, no, students would have easily understood. That's the reason they have used a very special language, net depreciation for the investments held for trading and etc. Okay. So, trading investments for a bank is a stock in trade. Trading investments for a bank is a stock in trade. So, very, very simple but a valuable statement for answer solving. Okay. It is a stock in trade. Okay. The net depreciation, that means reduction in the value, is a allowable expense net depreciation or the reduction in the value is a allowable expense or a deduction. It is already debited or credited. This is already debited or credited to the P&L. Therefore, no adjustments are required. Okay. Just a small little summary point, only for your reference I am just writing for your better clarification. Asset type land to a bank, it's a capital asset. Trading investments is a stock in trade. Cash is also a stock in trade to a bank. Okay. Fair enough. Let us go to the next point now. Point number 7. Okay. So we have managed this particular point. Bad debts written off in respect of advances classified as a loss assets. Very important point. So this is your bad debts classified in respect of the advances, So the bank gives advances. So in respect of the advances, it is classified as a loss asset. Wait for a moment. Provision for non-performing assets. Provision for a non-performing asset as per the prudential norms of the Reserve Bank of India. Both the things we can discuss it together. Okay. First of all, what is the difference and what is the question trying to tell us? It is saying that bad debts written off. This is a bad debts written off. This is already written off. And the second point 120 is a provision. So the difference between these two 13 and 120 as given to us in the question is that 13 crore rupees, because all the figures are into crores, is written off as bad debts. But it is not given to us, here that it is as per the norms of the RBI, as per these norms, that norms. Why they are not given? So I get confused. First of all, see, understand the difference in the language used in the question. Understand that language, and I told you when I began this question only that you need to pay more attention on the language of the question. Bad debts written off. So this is bad debts written off. Here, with respect to bad debts, it is not told to us it is as per the prudential norm. This kind of language is not used here. Why? They could have written, no, question paper could have written that this is bad debts as per the guidelines of the Reserve Bank of India or as per some guidelines of these and that, and like that they have not written. So what does that mean? I mean, does it make any difference? I mean, I have a doubt, baby. In majority of the earlier points you see, earlier, just the analysis of the question I am telling you. If you see the earlier points, it says that this is some market price as per the prudential guidelines of the Reserve Bank of India. Prudential guidelines of Reserve Bank of India. I mean, that kind of language, I feel that, oh, okay. As per the guidelines of the Reserve Bank of India. So I have that kind of a comfort level. Are you getting it? See, it's one of the earlier point also. The reversal of the interest was made on the basis of inspection report of the Reserve Bank of India in the month of September, blah, 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 blah. No, they have used that kind of language, but does it make any damn difference? So you got to think a little bit. I mean, you got to toggle your mind a little bit, and you need to, judge in the examination condition that why such a language is used. Okay. So I have a feeling. I mean, just understand. I have a feeling. I don't know whether I'm right or wrong, but I have that feeling. Okay. So it is bad debts written off. Okay. So who has written off this particular figure? No, who has written off? The bank. The bank. Okay. Who has told you to write off? The bank will say, no, we feel that we are not able to recover this money, so it is bad, and so we write off. So then you will say that then you write off. Why you are writing off 13? You write off 1,000 rupees. No, 1,000 crores you write off. Because everything that you write off, you are going to get a deduction. Just think logically. Anything which you write off, this is actually going to reduce your profits. Because look at the title here, it is debited and credited. So it is going to reduce the profits. So your total income will also be reduced logically, and your MAT calculations also, if any, will get reduced. So why you are writing off 13? You write off 1,000, no. Only one journal entry you have to pass. See, ultimately, the bad debts. What is bad? It's just a journal entry. You pass a journal entry, that's all. How did you arrive at this number of 13? I mean, that will be another question. Another good question to discuss in the course of the tax assessments. See, I am a tax officer. Suppose if I am a tax officer and if I see this particular company in my assessment, so I will ask the officer or the chartered accountant who comes for the hearing, I will ask him, how did you get this number of 13? That will show me the working first. This is not a magic number. 13 is not a magic number. How did you derive this? Because you have not printed anywhere it is as per RBI guidelines or these guidelines or that guidelines. Nothing you have printed. So you have to show me, no, that how did you get this magic number of 13? And if you are not able to show me, for example, and of course, not able to show me to my satisfaction will be an added point because I am a tax officer right now, then what I am going to do is, I am not going to allow you, I am going to add it back. And because I am a tax officer, I will also question that you have made a provision for non-performing assets as per the prudential norms. So I will have that comfortable prudential norms of the Reserve Bank. So you show me the norms of the Reserve Bank, some copies, black and white you will give. Then I will read and I will say, okay, these are the prudential norms. So I will say that, okay, this will also come. But again, I will question it. Because after all, it is a provision. It is not an actual bad debts. Because under the income tax, you don't get provision for bad debts as the deduction. You get the actual bad debts as the deduction. The fundamental principle of the tax laws. Otherwise, every Tom, Dick and Harry will make the provisions. By making provision, if the law has to give the deduction, it's the simplest way to reduce your profits. All my debtors are bad. I will say like that only. for example, and I'll make the full provision every year. So every year I will have loss only. That is not tolerated. That cannot be accepted, sweetheart. On top of that, if I am the income tax officer and if my income tax knowledge is reasonably good, then I will show you as an income tax officer some of the income tax law provisions that look at this, and then you tell me where you have applied this provision. Section 3617 and Section 3617A with respect to the bad debts for the banks. I repeat, bad debts for the banks, I repeat, is directly focused on these provisions. And I as an income tax officer will say, look, now you have showed me some black and white pages. Now I will show you some of the black and white pages you see I am showing you. Then I will say open the book, come to section 3617, 7A, etc. kind of provisions, and they are somewhere here in your business income provisions. I have already opened it. And see the page number on the screen and all that. This is your business income chapter, and these are the few pages. 1 second, see, 1 second. 3617 is somewhere here. In detail, we have discussed in the business income also, but this is just the bringing it to your notice. 3617A is here. Bad debts for banks and financial institutions, special provisions. And these two provisions, 3617, the bad debts, and 3617A provisions with respect to the bad debts for banks and the financial institutions. And 3617A is also on the next page, where certain percentage, the flat percentage of income, that is a total income, with respect to the foreign bank, because my SS is a foreign bank. So this is 5% of the total income is a flat deduction recommended by the law itself. Because law recognizes that in the banking sector, these bad debts are really a worrisome thing. Really a worrisome thing. So, law itself says that I'm going to give you deduction. And if you are, say for example, your local bank is not a foreign bank, so you are a Indian bank, say for example, then this is the percentage. So, certain percentage of the advance is made to the rural branches. You multiply with that percentage printed in the law and you get the deduction of A plus B. But our question is focusing on the foreign bank. Okay. And secondly, for example, I will tell you, just look at one example. Supposing if I assume that my total income is 200. Just imagine I'm taking that example with respect to the foreign bank, but that is also applicable to Indian banks. But that numbers will change. According numbers will change. Supposing if I believe that the total income is 200, 5% of that, this is the 5% of that, so that's going to be 10. Okay, this 10, you will get the deduction by creating a provision. Okay. And this is year wise. So every year you take 5%, 5%, 5%. That way. Is that okay? So this will be in form of a reserve actually. Or you can call it as a reserve for bad debts. Now supposing one particular year, the banker had a huge loss. For example. So this is actually a reserve. But the actual bad debts is, say for example 14. It is possible. See, 5% is something what is anticipated by the law. So we multiply and we give the deduction. Correct. But it is possible that one particular year 5 Vijay Malias were born. one particular year to this bank, 5 Vijay Malias were born. So they realized that in a particular year, we have 5 Vijay Malias to handle. So we have a lot of actual bad debts. That means my actual number is much more than this 5% which is anticipated by the law itself. Then what to do? Will I get the deduction only 5%? Are you getting it? So the law also has a remedy for the law also makes it very clear. Okay. If there is any extra bad debts over and above the reserves so created, can also be allowed as a deduction. But that over and above this 5% should be purely on an actual basis. And this particular point requires maximum attention of the students. I mean, students will really go nasty. So ultimately, if you want to put this particular concept in the computation format, because ultimately the student has to compute only, no? So if the student has to do this, baby, 1 second. Supposing if students has to put this particular concept in terms of computation, so how it will translate it into your computation format, okay? See, you will say profit as per P&L X amount. Okay, add all the provision or bad debts, whatever as per the books, add it. So bad debts or bad debts provision, everything as per the books we will add it. Just like a book depreciation add. This is all as per the books. Okay, thereafter we will less as per the percentage provided by the law, 5% of the total income. Because that is a standard kind of a deduction. I mean, I should not use the word sweetheart, the standard deduction, but it is a standard kind of a deduction. Okay. And thereafter, I will check the actual, pure actual. Does it cross that limit of 5%? If any, then I will use these provisions. Okay. And this will be my net computed total income. Ultimate structure of the answer will look like this. The concept ultimately used is the same concept. Book depreciation add and the income tax depreciation less. Same thing. But here it is little bit extra complicated. Because the bad debts classification to a bank is also governed by many more other banking rules and regulations. So that makes it little bit extra complicated. But anyway, we can handle it because you are my student, darling. So baby, if you want to make a note, first of all, you make a note of this particular small little format on your side page. Leave some 1 or 2 pages and just make a note of this. The standard manner of computation, that is a profit and loss, add book depreciation, add book bad debts, add book provision for the bad debts. So everything what is as per the books, you just add it. And then as per the tax, you less it. And there is of course one more extra technical thing here, that this is some percentage of the total. I'll take care of that technical things, friends. That will be in the computation format or the style and the strategy. All right. So now if you come to this particular point in the question, so this is something like your actual bad debts. This is something like your provision. Something like. But this is as per the books of accounts. So it is your actual bad debts as per the books of accounts. And 120 is a provision as per books of accounts. So everything as per the books, we are going to add it back. Is that okay? Shall I? Come on, let's do the adjustment in the computation. Okay. 6, then 7. Bad debts as per the books. The amount is 13. Provision for bad debts as per the books. That is your 120. Okay. However, as per the income tax, we have to give the deductions. I'll just leave some space here, if at all, but I'm not sure about that spacing. So I'll just keep it hanging for a while, because some extra adjustment if it is required. Okay. Now let's go to the next point. Indian branch share of executive general administrative expenses as per the debit note raised by the head office. It is called as a head office expenses. For the head office expenses also, there is a very special provision, particularly with respect to the international taxation, and if it is on actuals, okay, so that can be allowed as a deduction. Okay, so there is some monetary limit also, so but that we will not do that. I will again discuss it in detail. Very simple calculation, but it is in our international taxation topic of discussion. So head office expenditure within the limits and on actuals. Okay, so this particular amount, we assume that it is well within the limits and it is on actuals. That means it is not like, in your costing, you have that concept of, what should I say, absorption of overheads. So it should not be, this figure should not be based on some absorption techniques. It should be based on actual share of your head office expenses. So that should be allowed. Okay. So the next point is 9. Point number 9. Head office expense. Assume that it is on actuals and within the limit. Thus it is allowed. It is already debited. Okay. So there is no adjustment required on this particular front because we have already expensed that particular item. Okay. So this is already done. Let's go to the other relevant information. Point number 1. Interest on government securities accrued but not due. Interest on government securities accrued but not due for the last year, rupees 5 crores, which was credited to the profit and loss account for the last year. Amma mia, good point. What can you read from this, or what is that it is trying to tell you? See, I'll tell you this particular example. I mean, this is just extension of, look at this. Interest on government securities accrued but not due. Amount is 3 lakhs. Sorry, 3 crores, because all the figures are in the crores. Okay. Just refer the page. What adjustment we have done? Let me just scroll it back. Point number 3, you see, interest on securities not due. So for the current previous year, this 3 crore rupees was not due. So we have said we are not going to tax it. It has accrued, but it is not due. So we have not taxed it. Correct. But naturally, these 3 crore rupees, it is not due in the previous year. So logically in the next year, it will be due. Supposing I tell you that this was falling due in the month of the December and you have made investment in the month of the January. So for the current period, there is nothing due, because your date of investment is after the date of interest falling due. So naturally, next year, so that particular date will already come. The next year when the December will come, that time entire amount will fall due. So these 3 we have excluded from the previous year. That means from the current year I have excluded, but in the next year, so it will be included. I mean, that doesn't mean that these 3 will never be taxable. It will be taxable in the year in which it falls due. I repeat, these 3 we have excluded. These 3 we have excluded in the previous year, because in the previous year it is not due. But naturally in the next year it will fall due. It has to fall due. So in the next year it will be taxable. It is taxable only, but it is taxable on due basis. It will fall due in the next year. So next year it will be taxable. That's all. Now same thing is this figure. This point is again the same point, but it is with respect to the preceding year. It was accrued but not due for the last year. So supposing if you say that this was a before year and it was the current year, previous year. Okay. In the before year, that means in the last year, it is falling due here. But you have made the investment after the date of it falling due. So last year nothing was due, because your date of investment is after the due date. But the due date is going to come every year. So current year also the due date is going to come. Because supposing if your interest is payable annually, once in a year, so that once in a year is always going to come every year. So in the previous year, this particular investment will fall due. Of course, the interest portion, naturally. So this 5 crores is not credited, because last year it might have been credited on the accrual basis in the books of accounts. These 5 crores is not credited because this 5 crores was already credited here in the previous year. So in the previous year there is no credit, but it is a taxable income of the previous year because it has already fallen due in the previous year. So it is not credited but taxable. And this is the concept of interest on securities, always taxable on due basis. Have you understood that? So what I have to do is, this 5 crores, I have to include it in my computation for the purpose of taxation. Alright, darling? Come on. Shall I proceed? Come on. So, additional information 1, we'll have to use it now. After the point number 9, I think I can use this additional information 1. I'm just writing A1 so that, when you solve the question, you realize that this adjustment we have done with respect to that additional information. Otherwise, there is no special reason why I should write A1 separately. Okay. Interest on security is taxable on the due basis. So last year and the previous year. Okay. So accrued last year. Accrued in the last year. So credited in the profit and loss last year. Just for an understanding purpose, I am doing it. Only for you, I am doing it. So it is accrued last year. So logically, it is credited to the P&L also last year. 5 crores. Okay. Was it due in the last year? No. It is falling due in the previous year. Okay. So was it credited in the profit and loss of the previous year? No. Same amount cannot be credited 2 times, no, in the P&L. So last year it was already taken to the P&L. So taxable. Is it taxable in the last year? No. Why? Because last year it was not due. But is it falling due in the current year? Yes. So is it taxable in the current year? Answer is yes. But it is not credited to P&L. So I have to straight away add it to my income. 5 crores. The interest portion. I guess that you have understood this adjustment very well, darling. Oh, mama. Okay, baby. Is this adjustment very clear in your mind? Okay. Now, let us proceed. So, we have done this. Second point. Depreciation under income tax rules, we have already adjusted that. Okay. Point number 3. The assessee was allowed deduction of rupees 10 crores for the provision for bad and doubtful debts under section 36(1)(7)(a) till the last year. Very important point. Oh, mommy. Oh. And it has wrote off the bad debts for the first time in the previous year. Very important. What does this mean? Okay. Now, come to this particular page. Maximum attention is required. Huh? You should be in the good mood to study, darling. I'm telling you. Otherwise, you are going to create a problem. Okay. Let me erase all these things. Just put it in the terms of the time sequence. Previous year, before year, next year. That is our time sequence. Okay. Before year, next year. All decision of the bad debts and all that, we take it with respect to the previous year. So we got to give the answer for the previous year. But we got to analyze it historically that how exactly these particular figures are going to be arrived at. Okay. This 5% for the foreign bank is given a deduction to you every year. Let me just take up one example. Supposing your previous year, your income is 200, which is this total income, multiply with 5%, so you get 10. So your previous year, your amount of the deduction is 10. but supposing your actual is only 3. Possible? That means your actual bad debts is not up to the 5%, but still the loss is up to 5%, so we are anyway straight away going to give you the deduction. It's like a standard deduction. Don't use the word standard deduction. So if your actual is not so much, so it's okay, you should be happy, no? Because law is anyway giving you on a presumptive basis some X percentage as a deduction. So banker should not have any problem because you never have the actual bad debts. Is that okay? Supposing if your actual is 15, that means your actual is more than what is already provided by the law itself. Now the banker will have a problem. Oh my God, we have lost more money, and because we have lost more money, oh no, we want more deduction because this 5% is not sufficient enough to meet our loss. Then this provision will come. Then the law will say you take deduction here and plus we will give you a deduction of 5, which is the section number will change, but we will give you the deduction. Because you have actually lost some more money. Simple as that. Okay. Now take up a small little different example. Let me go to the before year. In the before year, you got a deduction of 10 as per 5% multiplication, but the actual was only 8. Your actual bad debts was only 8. So nothing wrong. So in the preceding year, you have created a reserve account. So reserve is created by 10, but the actual bad debts is only 8. So you will write only 8 off in the reserve account. And nothing will be wrong because, okay, banker will say we are happy because you are giving us deduction of 10, but we are actually the money that we have lost is only 8. So we are okay with that. I mean, we have no greater complication. But the income tax officer will say that, look, 2 extra deduction we have given you. That means you already have an opening balance to the reserve of 2 in the next year. Is that okay? Now in the previous year, again 10 you are getting the deduction. Supposing the actual is 11, one more. So banker will say, oh my God, we have lost one more, 1 crore extra we have lost. So you give us a deduction of 1 crore extra. Okay. But now income tax will say, no, you cannot get 1 crore deduction now because last year will give you 2 crore extra deduction. So this opening balance will have to get adjusted here. It's a ledger account. Mamma mia. That means ultimately it's just like your ledger account. You are creating reserve to the extent of 10. In my example, every year, assuming that every year your income is 200, so 5% you multiply, assuming also that every year the rate is 5%, because these rates also sometimes keep changing. Okay, so assuming that every year as per the income tax law you are getting deduction of 10, it's an assumed thing, friends. Okay, and you will have the actual deduction, but it is not just 10 calculated in the air. This is what I'm trying to tell you. It is like a reserve account. So reserve account, if it is more loss, then you will get the deduction more. How does this translate in your given question? Understand that. And this data is already printed in the question. Very smartly printed in the question. Okay. Now look at this particular point that we are discussing. Assess your allowed deduction of 10 crores provision for bad debts under 36(1)(7) till last year. See, till last year. So you have a ledger account. You were given 10 crores deduction for this particular on 36(1)(7). 36(1)(7) is a provision. Okay, so you have created a provision for 10 till last year. That means your opening balance of the current year, the provision is 10. Okay. it has wrote off the bad debts for the first time. It has wrote off the bad debts for the first time in the previous year. So how much have you wrote off? You have written off 13. So your actual bad debts which you write off from this particular reserve is 13. This is your opening balance. So you will wonder that no, I want the extra deduction of 3, but no, because current year also provision you have to create. So current year also 36,178 deduction you have to create, but that we have still not calculated. So 36,178 of the current year will also be created as a reserve. Compare it with 13. Compare it with 13 and then give the deduction under section 36(1)(7), the general deduction, because 5% reserved anyway you are going to get the deduction. It's like a standard deduction. Correct? Now supposing if current year 36(1)(7) is only 2, supposing it's an assumed number. So your total reserve is only 12, but the actual is 13. So you will want one more extra deduction. And that one more extra deduction will be under general provision of 36(1)(7) and not 7A. And this is how the provisions of 36(1)(7) and 36(1)(7A together is to be interpreted. So to the extent of the reserve creation, that's the standard deduction, but if your actual is more than the standard deduction, then you will get the actual extra to the extent of difference. Mamma mia. And that is the special reason. That is the special reason why the question is printed that it has written off the bad debts for the first time in the previous year. But supposing if this data was not printed in the question, then I cannot draw the ledger only. That multiple year ledger of reserve, which I will like to draw, I cannot draw if this data was not printed in the question. There is a very special reason why this data is printed in the question, darling. That it was written off as bad debts for the first time. That means up to this year, you only created reserve. That means you never had actual bad debts. And this year, the previous year, for the first time you have the actual bad debts. That's the meaning of this sentence. And that makes a big difference in my ledger calculation. Without this particular data, I had to get confused. Have you understood that? Have you understood that? Okay, so that we will use it, but generally these calculations are always done at the end. So this point is linked with your 13, which is your actual bad debts. Okay. And this 120th, anyway you don't get the deduction because it is only the provisions. So provisions you are not given a deduction. So both the points together will be taken care of. So your actual loss is 13. So for comparison purpose with 5%, only actual figures will be used. Provisions will never be used. Okay. So that we're going to do at the last, the working. So wait for a while. Then interest on substandard doubtful categories. The next point. Or maybe let me just update this particular answer so far on this particular point. Okay. But I cannot solve it finally, but I'll just create a structure of the answer so that I don't miss out, darling. Come on. Okay. So I come here and come under the head capital gains. Okay. So how does my answer look like? Just look at the format. My actual bad debts I have already added. Provision for bad debts 120 I have already added. So 13 is actual and 120 is okay. Now I have to give the deduction of 36(1)(7)(A). Okay. So That will be my last adjustment in the business income. So I'll say that business income before the deduction. Business income before 3617 or 7A. Okay. Then the deduction. Now I don't have the space because I miscalculated the space. So I'll have to write a working note. Okay. So working note I will write. Then I will get the business income. This will be as per income tax. So business income I will have, and then I will have the capital gains. After the capital gains, I will have my gross total income and the total income. And after the total income, I will be doing my tax liability calculations. So this is the structure of the answer. Come on, have a look at the answer. So far, so good. So business income before 3617A, 7 and 7S. 3617 is a general provision for bad debts, and 3617A is a specific provision for bad debts, like a standard deduction, not a standard, like a standard deduction. For that, I'll have to write a working note. Okay, and previous all adjustments I have done. So before I start using the calculator, I'll have to do this particular working and the calculations. Okay, and then the total income. After total income, I'll have a tax liability calculation. So I will again update my structure of the answer. Tax liability calculation. There were total income, rate, and the tax amount. Surcharge on merits, cess. The total income, rate, and the tax. You should not forget, here it is a foreign company, so the rates of tax of the foreign company will apply. Surcharge, if any, on merits, that means surcharge is linked with the total income more or less. I've already given you that particular data in the rate card. Cess, you will multiply, use the calculator at this stage and get the total tax liability, and we have to ignore the provisions of the MAT. Structure of the answer. And that bad debts calculation, I will do that working note. So 3617 or 17A. But this working note I have to develop at the end, because still all the 5 points I have not read. Okay, so that's the reason I'm waiting. So this is done. Assess yours allowed, we have discussed that, but you have to develop a working for it. We'll do that. Now, next point, interest on substandard categories. Interest on substandard and the doubtful categories of the advance not recognized as income. Not recognized as income means it is not credited to the profit and loss. It is not recognized as income. As per the prudential norms of the RBI, that is 15 crores. So that is fair, no? That means this, to the extent of 15 crores, it is not recognized, and it is not even the income. And here your concept of revenue recognitions come into the play. I repeat, your concepts of revenue recognition comes into the play. Here it says that interest on substandard and the doubtful categories of the advance. So it is already on a doubtful category, and the doubtful category is again as per the Reserve Bank of India guidelines. So it is doubtful. So you cannot recognize interest income because it is all in the doubtful category as per the RBI guidelines. So in the given case, it is not credited to the P&L. So it is not credited naturally, and that's the reason it is in the other information. That is the reason this particular point is printed to you in the other information, because your table what is printed here is already debited and credited. So all the table items are debited, credited. Other items are not debited, credited. So it is not credited, and it is not even the income. So you don't have to do any adjustments here. But you have to write a comment there. You have to write a comment there. Okay. So this one point we have to write. Then the land at Noida we have already read and we have already adjusted. So after doing this 15 crore comment, we can straight away go to the bad debts calculation. So now these two things remain in this question. Okay. Come on. Come on, come on, come on, come on. Come on, sweetheart. Okay. So I'll write that comment here first. This is my additional information for. Okay. Interest on substandard assets. Interest on substandard assets, that is your bad loan logically in a simple English, is not to be recognized as income. No adjustment is required, and it is not even credited in the P&L because it is in the additional information. It is not credited and not even supposed to be credited. So it is no adjustment in the income computation. Is that okay? Shall I proceed? Now the real hardcore bad debts provision. Come on. The working note for 36.1.7 and 7a. Here the students again do lot of mistakes. Okay. So I'll do it both the ways. I'll show it to you in the ledger format also. I'll show it to you in the computation format also. Okay. Both the ways. Okay. So first of all, ledger. Reserve for bad debts, and this ledger will be given the name as 36.1.7a. Opening balance brought down is 10. Opening balance brought down is 10. How can I definitely say that opening balance brought down is 10? It has to be read in the question. I again and again repeat because here students will go wrong like anything. Okay. Interest, come to this point number 3. Assessee was allowed a deduction of 10 crores for the provision for bad and doubtful debts. Provisions means 36.1.7a. Okay. Under 36.1.7a already printed also. Till the last year. So till the last year you were given a deduction of 10. Okay, from here the new sentence, the new part of the sentence start, and it wrote off blah blah blah. That means up to the last year you were given a deduction of 10 on account of reserve creation by multiplying 36.1.7a percentage. Okay, and you have wrote off the bad debts for the first time in the previous year. That means up to the earlier years you have never written off any bad debts. So you only got that 5% standard deduction every year, and the total of every year is 10 rupees. Have you understood that? So if you put it in the time sequence, supposing previous year, before year, before year, before year, okay, you have already got 36.1.7 as standard deduction. Many years you must be getting. So every year you create a reserve and every year you get a deduction. So you have amount of 1 year, amount of 2 year, amount of 3 year. Every year the ledger account gets carried forward. Opening closing balance of the ledger account, because This reserve has to be reflected in the books of accounts. That is also a mandatory condition, friends. And you have return of the bad debts for the first time in the previous. That means up to the previous year, there was no actual bad debts. So your bad debts first time is this figure of 13. Okay. Now you will have to update your ledger. This is a balance brought down. So you have to update current year reserve creation of 3617A of the current year. Okay. So of the current year deduction under section 3617A, okay, that is 5% of the total income. Total income means your business income plus your capital gains just before giving this particular deduction. Okay, so start using your calculator now. Come on. 5% of this figure total, please calculate. Look at the answer. Okay, so your business income total you do. So this is your before is 183. Take the total. So it is 183 plus 4.42. Okay. So 5% of the total income, that means business income is 183 plus 4.42 is your capital gains. So it is 5% of 183 plus 4.42. That is your limit, and that amount comes to 5% of this comes to 9.37. This is your reserve creation. So this is your 9.37 current year reserve creation. So total reserve deduction amounts to total 10.10 plus 9.37. And how much is the actual? The actual is 13. And this actual for the first time you have. And this statement of first time is very important in the question. Only then you can assume and accept that the opening balance is 10. So now your actual figure, your actual is not more than the opening balance of the reserve plus the previous year of the reserve. Opening balance is 10, previous year is 9.37, your actual is only 13. It is not greater than, your actual is not greater than this figure. That means 3617, the general deduction is not allowed. That's the real key conclusion here. Real key conclusion here. Yes. Students will really find it difficult, but I'm telling you, you should have understood this. If you have not understood this, call me immediately, baby. Have you got this? So if you come to this particular page now, again here, Okay. Come, baby. Okay. See, this is the amount of the deduction you are getting every year. Extra bad debts deduction over and above that 5% standard deduction. I am just using the word standard deduction for the sake of simplicity. Don't write in the exam, friends, standard deduction. Your extra bad debts over the reserve. These extra is nil. And you are getting this deduction because your actual is anyway within the 5% limit. But this is with respect to multiple years calculation in form of a ledger account. Oh, mamma mia. And you have to clearly, supposing if you skip this particular point, no, in the examination condition that 3617 is not allowed. If you are not able to decide this particular thing in the examination condition, your answer is a substandard answer. Keep that in mind. Is that clear? So, what is the ultimate total deduction? Ultimate total deduction is 9.37. That's all. No extra deduction. Okay. So, come here. 183. Deduction working note as per income tax. It is 9.37. That's all. Okay. So, take the balancing figure 173.63 plus your capital gains, so you will get a gross total income. Use your calculator, that is 178.05. Total income is 178.05. And then straight away go to the tax liability calculation. 178.05, but this already includes your long-term capital gains. So you'll have to break up your rates of taxes. The total is 178.05, but there is a special rates of tax. Is that okay? So you have to update this particular table. Okay, so you have to say LTCG 4.42, balance will be 173.63, rate, tax, long-term capital gains, and the normal rate of the foreign company I have already given you in the rate card. Surcharge, you got to apply it, friends, only when your income exceeds a certain limit. This is a foreign company. So friends, you guys have to multiply the rates of taxes of the foreign company. Now you have to update this particular table, friends. How did I come to know that this is a long-term capital gain? Because that index cost was printed in the code. I mean, I can take that particular hint and take a call there from that only that long-term gets indexation benefit, and so it is my long-term. Surcharge, don't do the silly mistake, friends. It is with respect to the foreign company, and I'm telling you again and again, rates of tax of the foreign company will apply here. But long-term capital gains itself is a concessional rate of tax, so you can take that particular number. And the cess. So multiply this particular figure, complete your tax liability calculations. Check out your full answer, and in the given question you guys have not to do any math calculations, so only one tax liability figure, and that is your tax liability based on the total income. Have the final look of the answer. So many times I have already shown you. So this is your ultimate final look of the answer. And I guess that now we can imagine why this kind of question is almost 16 mark, 20 mark type examination condition. Oh my God, it's a beauty question. Students will do a lot of mistakes. People whose concepts are not clear, they'll do a lot of mistakes in a question like this. And this is your final look of the answer. Have a look.